And I hope you're having yourselves a good week so far. It's a good week for us here. And of course, today, as it's a Tuesday, we look specifically into the debt markets and how they are working right now and what the rates are right now. Thank you very much for deciding to spare time for us, and we won't disappoint you. You can catch this show every weekday, Monday to Friday, at exactly 10:30 a.m. to 12:30 p.m. And here we specifically look into financial markets in Uganda and see how we can grow these markets and around East Africa as well. And today, in a particular way, we will look at the debt instruments. If you want to know about the rates currently on the Treasury Bonds and the Treasury Bills, stay tuned for more of that action. And of course, we'll catch you every weekday for that more details. Now, today, as it is the second day of the week, we also look at the stock performance for the stock markets. That is, when you look at, for example, right now, the 18 listed companies, and of course, on the Nairobi Securities Exchange as well, there are quite a few changes because in Kenya, the election is done and the petitioning is also done. And even today, we are seeing the swearing in of their new president, Mr. William Ruto. And so there is an improvement generally in the performance of the markets. And there is hope that it will even get much better with time, definitely moving forward. Now, if you have been following through the stock market's performances here on the Uganda Securities Exchange, there was also still a sluggish kind of movement in terms of the people who are trading and also the turnover. But recently, we are seeing that the markets are getting better and people are getting to participate more as we wind up, of course, the third quarter of the year. We're coming to almost the half of September, and by the end of September, we'll have finished 3 quarters and headed for the last quarter of the year. And we, as of course, financial analysts and experts, we always want to see and look at things from an angle of time. We always, time is very important. This is a time when companies are winding up the year and they are trying to see that they put their books in order and make them right. And so this is a time also for you to look out for which companies you can actually bet on to see that you grow your money, you see that you add value to yourself as an individual, as an institution, and definitely as a group of people who are going to invest and put aside money for investment. The Uganda Securities Exchange is the lead in this, of course, giving us data that we utilize here to analyze and also get to give you our personal views, but also expert information and, of course, advice, giving us, of course, a way forward through the stock brokerage firms, the fund managers, and so on and so forth. And for all those who are on our social media, on Twitter, you're doing a very wonderful job. You can always, give us a comment and leave a question behind, and we'll be able to respond to that particular question and get to look at how things are running at the moment. But looking at the stock market yesterday, yesterday's trading was actually wonderful. There was a good number of people who traded on the stock market yesterday. And checking here on the data analysis, we see that yesterday 4 companies participated in trading, ending the day with 3 gainers and 6 losers, unfortunately. The gainers included Nation Media Group, who led by a 4.33% increase to a price of 597. And then we had MTN Uganda at a 0.95% increase and gaining to a price of 185. And then we also had the Stanbic Bank Uganda, who gained by 0.14%, closing the day with a price of 21 shillings. Those were some of the top gainers whom we shall look at later on, of course, in detail. The other side of the losers, we had 6 losers, unfortunately, but most of these, if not all, they were from Kenya, cross-listed from Kenya, led by, from the bottom, of course, by Centum Investments, who lost by 9.54% yesterday, closing the day with a price of 288.56. We also had KCB come out as a loser at a 0.80% loss, closing the day with a price of about 1,346.09 Ugandan shillings. East African Breweries Limited also lost on the markets yesterday at a 0.74% loss, and he lost to 4,851.63. Then Equity Bank Limited also came in as a loser at a 0.61% loss, closing the day with a price of 1,541.11 Ugandan shillings. And then Jubilee Holdings Limited at a 0.2% loss, lost to 7,768.95. Whereas Kenya Airways lost by 0.09% to a price of 121.45. Those were some of the bottom losers. Well, the market actually declined in terms of when you look at the all-share index, it went down. We're going to look at that a little bit later. But also the local company index performed much better. It increased because of the 2 top gainers who are domestic listed companies, that is MTN and Stanbic Bank Uganda. So generally we can say that the markets here in Uganda for the domestic companies overall moved in the positive direction. But when you look at overall performance for all the listed companies, we still had a decline in the performance there. Before now we look at the deeper analysis of that stock, we would like to first draw our attention to the debt market. Remember, financial markets are very diverse with different sectors that are being addressed here. We basically have borrowers and lenders meeting on a common market to see that they exchange securities or financial instruments. Now, on the debt market, as we all know by now, we should know, we have the long-term debt instruments and the short-term debt instruments. And when we talk about debt, it is simply borrowing. And it depends on who is borrowing to name a certain instrument. For example, when we have a Treasury Bill or a Treasury Bond, these are debt instruments to government. We are seeing the public lending money to the government in a short term and in a long term. When it's on a short term, we call it a Treasury Bill, and that is an instrument that is about a year or less, actually less than a year. And they're divided into 3, mainly here in Uganda. We have the 82-day bill, and we also have not 82, we have the 91-day bill and the 182 bill, and that is 3 months and 6 months basis. Then we also have the 365-day bill. That is a 1-year instrument there that are listed. These have been listed for some years now, and there have been quite many that have been issued. And these are regulated by the Treasury Bills Act in 1969, which was imposed in 1969. So they have been in play for a very, very long time. However, we also have the Treasury Bonds that are just not as old as the bills here in Uganda. The Treasury Bonds are longer term instruments. We're looking at lending governments on a basis of 2 years, 3 years, 5 years, 10 years, 15 years, and even 20 years periods. And these bonds are issued, of course, to help governments get money, to get money actually to be able to provide social services, to be able to do government business. And they return an interest every after 6 months. You have an interest, or what we call a coupon, come in at a coupon rate given the amount of money you have invested. And when you want to invest in any of these instruments, the minimum amount is 100,000. Now, we looked at the CMA report, or the Capital Markets Authority report, for the second quarter of the year 2022. And according to this report, under primary activity, like we know on the stock exchange, we have a primary market and we also have a secondary market. Likewise, the debt market still has a primary activity and a secondary activity. And when you look at the primary activity, you're looking at Bank of Uganda issuing directly to either particular individuals or to primary dealers. And these primary dealers are financial institutions carry out secondary market activity of these treasury bonds and bills, or these financial instruments. And in Uganda so far we have just eight primary dealers, including Absa Bank, including Bank of Baroda. We have Centenary Bank and Stanbic Bank. We also have UBA, who just recently joined in 2021. We have Standard Chartered Bank, as well as Housing Finance Bank and DFCU, or Development Finance Company of Uganda. These are licensed to carry out secondary trading of the debt instruments. That's the treasury bonds and the treasury bills. However, they themselves have their primary marketing, where they go directly to Bank of Uganda during auctioning to be able to get some treasury bills and bonds to be able to put on the secondary market. Now, Bank of Uganda during the second quarter of 2022, that's from the month of April to the month of June, it issued a total of 2.6 trillion Ugandan shillings. This is money that is issued. This is money that is put up for auctioning on the primary market. And this was 2.6 trillion worth of treasury bills and treasury bonds within these 3 months in the second quarter of 2022. Now, this is 16.6% lower than the 3.1 trillion which was issued in the first quarter of 2022. We're seeing a decline in the amount. And of course, we will also look at the third quarter when we come to the end of this quarter and analyze some of the bills and the bonds that have been issued by Bank of Uganda. But as per the second quarter, which we have already covered, we see that there was a slight decline in the amount of money issued on the treasury bills and bonds by the Bank of Uganda. And the decrease in the debt issuance can be attributed to, among other factors, the rejection of the bids that were highly priced. Remember, we're going to break down this procedure of auctioning on the primary market, but basically, when you're looking at issuance of treasury bills and treasury bonds, we have what we call bidders, and these are people who come in to actually at the auction. They're present, either commercial banks, institutions, and so on. But these are usually primary dealers. Now, when these people are going to auction, they come in with their own interest rates with which they would want to have the bonds or the bills or these financial instruments or assets. And sometimes the banks, the central bank or the Bank of Uganda rejects some of these bids. So because of this rejection, we're seeing that there was a slight decline in these in the monies that were actually gotten from the treasury bonds and bills. So this definitely comes with consensus within the Bank of Uganda to come up with a rate and neglect all other rates that have been, or reject all the other rates that have been coming in through the bids. Now, when you look at the maturity, when you look at the second quarter, so we are comparing how the bills have been changing or the bonds have been changing with time, the amount that has been issued. In the second quarter last year, 2021, we had 2.8 trillion, whereas in the third quarter, for the same year, 2021, we had 3.3 trillion. And in the fourth quarter, we had a much lower 2.78 trillion. And in the first quarter, 2022, like we've seen, we had a 3.1 trillion. And in the second quarter, we had a 2.5 or close to 2.6 trillion Ugandan shillings that was issued. Now, when you look at the yields on the primary market, now remember yields, we are looking at the interest rates that are coming in within due to these, of course, treasury bonds and bills. Because as investors, you're looking at a yield, you're looking at what return am I going to get back. When you look at in the primary market, the 2-year bond yield fell while the yields on all the other tenors edged upwards. Now, remember we said the bonds are 2 years, 3 years, 4 years, 5 years, 10 up to 15 years, and even 20 years sometimes. Now we're seeing that all the other bonds had an increase in their rate or in their yield, apart from the second-year bond, which fell. Now yields on the 3-year bond, the 5-year bond, the 10-year bond, and the 15 and 20-year bonds, treasury bills grew from average yields of 12.1%. That is for the 3-year bill. When you look, the 3-year bond. When you look at the yield on the 3-year bond, it grew from 12.1% to 12.4%, whereas the yield on the 5-year bond grew from 14.0% to 14.5%. The yield on the 10-year bond grew from 13.5% up to 13.5% up to 13.8%. Whereas when you look at the 15-year bond, it grew from 14.4% to 14.5%. And the 20-year bond grew even more from 16% to 17%. So you're seeing there was an increase in the rates within this period. The increase is partly explained by a recent central bank rate increments, and that have pointed to a tightening monetary policy by Bank of Uganda to tame inflation. When you look at the central bank rate, it was changed 3 times within a space of almost less than 2 months. And this came from, of course, due to the inflationary pressures that were experienced within the country. And the central bank, that's the Bank of Uganda, could not just look on. So they decided to start decreasing from it was around 6%, 6.5%. It went to 7%. Then later on, it moved from 7% to 7.5, actually 8.5%. And then later on, from 8.5, it moved to 9%, where it is at the moment. And we are going to also analyze what is the effect of this central bank rate on you and me as consumers. Despite us being investors within the financial markets, how does the central bank rate affect you and me as consumers? Now, that said, the 2-year bond sold for over 9.9%. And when you look at this 2-year bond in the second quarter, compared to an average of about 10.5% in the first quarter of 2022. On the annual basis, the yields on the 2-year, 3-year, and 5-year treasury bonds dropped from averages of 12.3%. Now, when you look at on the annual basis, you're literally looking at 1 year yields, what you're getting every single year. Those yields actually fell for the 2-year, 3-year, and 5-year treasury bonds, dropping from 12.3% for the 2-year bond to about 9.9%. Whereas for the 3-year bond, it dropped from 12.8% to 12.4%. And on the 5-year bond, it dropped from about 15.1% to 14.5% respectively. And now, on the other yield, we see that the yield on the 10-year and the 15-year bonds rose from an average of 13.7% for the 10-year bond to 13.8%, and from 14.4% on the 20-year to 14.5% within the second quarter. And you can see more of that statistics here that are based on this quarterly report of the Capital Markets Authority. Now, why do we need to mention this? Because many people have not realized how important it is at the moment to make use of their money to get a little bit more money. You can lend to government, and it's possible. So long as you're 18 years and above, the policy is very clear. It's 100,000 and above, and you have to go through a primary dealer to be able to get some of these financial instruments. These are ways the government gets money, but also ways for you to be able to make use of your money to get a return. And when you look at some of the guidelines that we follow, the policy is very clear on who can invest in the government securities. Number one is the commercial banks. If you're a commercial bank out there and you would want to lend government money, it's an opportunity for you to do this. The insurance companies as well that are also legible investors in these government securities. We have the individual companies. If you have your own company, you're making some money every year, and you feel like you need to further your investment, yes, you can consider government securities. Then pension funds, very, very much clear here. We've seen NSSF also construct houses for some of their beneficiaries there. And some of the ways they grow their money is through investment in government securities, lending to government. This is the way they raise that money, the way they get to add value to the beneficiaries' money. Now, we also have individuals, so long as you're 18 years and above. So if you're out there, maybe you have a cake business, you are a baker, you're baking, it's absolutely fine. You can still get yourself some money that you're investing, that you're saving on your business, and invest it in government securities. There are also offshore investors. Those are individuals or corporate entities through a local agent or their primary dealer as well. They can still do this investment for themselves. Now, what are some of the advantages of investing in government securities? Well, number one, they're absolutely risk-free assets. You're not going to lose your money. It's not like the stock market where today I'll come and tell you MTN has done this, and tomorrow it's a different story. You are absolutely protected. You know that your funds will return to you because government cannot default. Of course, maybe there's there are few instances where we've seen governments really default, but not in Uganda at least. Government will always pay back, because even if government changes today or tomorrow, they will still have the mandate to clear this debt. So they will still have to settle your claim. Now, there is also offering a competitive rate of return. When you look at businesses in Uganda, not many can give returns as much as these government securities, at least within the specific periods of time that these instruments are issued. Of course, there are businesses that could do probably well or competitively well as well, but it's not easy to find one, especially when you don't have to work a single day for this return. Government securities offer you a very competitive rate of return on your investment. There's also providing a saving mechanism. Sometimes it's so hard to save without a purpose, or saving without a goal, or without any reward on your saving. So these instruments or securities of government will give you a chance to also save for a purpose and save with a goal which you are aiming at. They can also be pledged as collateral during borrowing. So if you want to get a loan from a bank, you can use your instrument or your security, your government security, your treasury bond as a collateral. So that's still another benefit that can come off investing in some of these financial assets. All right, we're going to take a quick breather. When we return, we wind up this topic. We want to really break down this for you and make it easy as possible for you to understand and make your first step towards investment. Stay with us. We'll be right back for more.